Happy Friday, gang. Were you on the Pro Ticker app yesterday? Because wow, my alerts generated a cumulative 1,118.4% in long moves. That's not just a good day. That's a where's my screenshot folder kind of day. Check this out. SPHL, 642.9% long move. CJMB, 193.7% long move. And there was more. It was non-stop. Charts lighting up all day like someone spilled an energy drink on the NASDAQ. And the love has been unreal. Emails, DMs, people coming up like, yo, was that you? So I just want to say it. I love you guys. For real. Now listen, after hours, I dropped an alert for VERO with a 2.44 long signal. And this morning, now in the pre-market, a few minutes ago, it just hit 6.33. Let me say that again so it hits the brain properly. 6.33. That's a 159.4% long move from yesterday to today. Can you even grab it? Like, be honest, did your hands even work fast enough? Because the whole market was going crazy about VERO yesterday, and the whole market is going crazy about VERO today. But you guys, the Pro Ticker users, you already knew about it yesterday after hours. That's the difference between chasing the headline and being there before it becomes the headline. All right, enough flexing. Let's talk about what actually matters. What I'm watching today and into the next few days, and the market insights you need on your radar so you don't get caught reacting late. Quick note, not financial advice, I'm just here to translate the chaos into English. Today's big picture, the 3 to 5 stories steering the ship. 1. Stocks bounced Thursday on a banks and chips rally. Dow up 0.6%, S&P 500 up 0.3%, NASDAQ up 0.3%, and early Friday pricing is still leaning green. So the tape's like, we're good. But the headline machine is like, you sure? 2. The Fed cuts soon story keeps sliding. CPI up 0.3% month over month, 2.7% year over year. Jobless claims fell to 198,000. That combo makes traders push out rate cut expectations. Translation, the market keeps hoping for easy money, and the data keeps saying, not so fast. 3. Fed independence is now a market variable. Trump told Reuters he has no plan to fire Powell, but investors are already watching the bond market like a hawk, because policy uncertainty can mean higher long-end yields and a steeper curve. And if you only remember one thing today, remember this. Long rates can ruin a perfectly good stock rally. Valuations don't care about vibes. They care about discount rates. 4. AI got a fresh catalyst. TSMC beat expectations, talked up robust growth, and signaled more U.S. capacity. Add a new U.S.-Taiwan trade deal putting chips and investment center stage, and suddenly semis have a brand new narrative engine. 5. Crypto hit a policy speed bump. A key Senate hearing on market structure legislation got postponed after Coinbase objections, and Bitcoin drifted back toward the mid-$95,000 area. Translation, crypto still trades policy headlines like earnings reports. What actually matters? The stock whisperer filter. Here's the clean way to think about today. The tape is saying, risk on. The macro is saying, watch your footing. The rotation is real, and it's healthy. Small caps hit a record high. The equal weight S&P has been outperforming since year-end. Why it matters? When leadership broadens, rallies get sturdier, because we're not relying on the same handful of mega caps to carry the entire market like it's moving day. Who tends to benefit? Cyclicals, industrials, value, and cash flow names. Who gets sensitive? Ultra-expensive, long-duration growth names when rates act up. Fed cuts and lower long rates are not the same thing. Fact, the curve is already steep. 2-year around 3.56% versus the 10-year around 4.17%. Why it matters? If the 10-year climbs because investors demand more compensation for policy uncertainty, stocks can still struggle even if people keep chanting cuts later. The Powell DOJ story isn't drama, it's term premium. This is a bond market credibility story. When credibility gets questioned, investors ask for more yield. More yield means higher long rates. Higher long rates means tougher math for equity multiples. And Wall Street's quiet fear? You try to win lower policy rates and accidentally push mortgage-linked yields higher. That's how you break housing affordability without even trying. AI is back driving, but now the market wants proof, not vibes. TSMC delivered record profit and talked up expansion. Semis caught a bid. The AI complex got revived. But watch the nuance. People still treat AI capex like one giant blob trade. 2026 is going to separate the real infrastructure winners, tools, power, data center supply chain, from the "we said AI 200 times on the call" crowd. And energy's getting tugged in two directions. Oil dropped as the Iran risk premium cooled, but M&A chatter says majors still want scale and high-quality inventory. Translation: near-term price pressure, but companies are still positioning like the assets matter. Market implications: what you can actually position around. Equities are still constructive early Friday. SPY up about 0.24%, QQQ up about 0.31%, and the DIA up about 0.6%. Rates: the curve is steep and the long end is vulnerable if the Fed independence narrative heats up. Commodities: oil is unwinding its premium, with Brent around $63.6 and WTI around $59.1. Gold is slightly cooler but still near record highs. Crypto: Bitcoin weaker, hovering around $95,000. Now the regime shift check. Stocks are acting risk-on, but a firm dollar and gold near records tell you investors still want hedges. Translation: volatility likely stays elevated because policy headlines can move rates faster than fundamentals can adjust. And don't forget the calendar. Monday, January 19th is a U.S. market holiday for MLK Day. That means liquidity gets weird, reactions get exaggerated, and Tuesday can feel like everybody hits refresh at once. Sector-level breakdown: where the wind is blowing. AI and semiconductors look bullish. TSMC validates the real build-out. The U.S.-Taiwan deal supports investment momentum, and the risk to watch is China policy spillover. Financials are bullish, with a policy overhang. Earnings helped sentiment and deal-making is back in the conversation, but the wild card is political interference, things like the credit card rate cap idea. Industrials look bullish. Rotation money loves real economy and cash flow, and the group is acting like leadership. Energy is neutral with a bearish near-term bias. De-escalation removes the risk premium, but M&A activity suggests longer-term asset value is still attractive. Small caps versus large caps. Bullish, small and mid. A record high in the Russell and strength in the equal weight index say this isn't a mega cap only market anymore. The threat is a sharp jump in long rates. Growth versus value is neutral, more of a barbell. You can have semis leading while value wins at the margin if rates stay sticky. Dispersion is the move. And crypto is neutral to bearish. Long-term direction is still positive, but delays and rewrites mean choppiness. Forward-looking outlook: the next few days and the next few months. Over the next few days, the base case, about 55%, is a choppy grind, higher led by semis and selective financials, with yields range-bound but biased higher on governance headlines. The left tail risk, around 30%, is the curve steepening the bad way. Long yields jump on credibility fears, and housing-sensitive names and long-duration equities feel it fast. The upside risk, about 15%, is earnings beats and calmer politics broadening the rotation further, pulling small caps and industrials higher. Looking weeks to months out, the most likely outcome is that earnings keep the tape supported, but multiple expansion stays capped as cuts get pushed out and term premium remains elevated. Translation: bigger rotations, sharper winners and losers, and stock picking matters more. What to watch next: the calendar and the red flags. Monday, January 19th, U.S. markets are closed for MLK Day. Next week's earnings include Netflix, J&J, and Intel, and guidance is going to matter more than beats. Wednesday, January 21st, Supreme Court arguments on Trump's attempt to remove Fed Governor Lisa Cook, plus questions around tariff legality. Friday, January 23rd, the Bank of Japan decision. Earlier hike chatter and potential foreign exchange volatility are in focus. And January 27th through 28th, the FOMC meeting with attention on the Fed's tolerance for sticky inflation components. And here's the red flag dashboard. Watch 10-year break-even inflation, the 2-year versus 10-year spread, and any escalation in the Powell DOJ storyline. So here's the bottom line. The market's got momentum. The rotation is real. Semis have a catalyst. Financials have fuel. But the bond market is the boss fight. If long yields stay calm, stocks can keep climbing. If long yields pop on credibility headlines, things get messy fast. All right, gang, drop a comment. Are you watching semis, small caps, or are you playing it defensive into the holiday? And if you're on Pro Ticker, you already know what time it is. Have a safe Friday. Stay sharp. Catch you on the next one.